Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, a Chartered Market Technician and Portfolio Manager. Thank you so much for joining us here as we enter the second half of the year, believe it or not. I say that every year, but boy, it's hard to believe that July is already here and we'll be celebrating the 4th. But nevertheless, we're here and we've got a couple of, I think, important topics to talk about and give you. We're going to talk about Fed policy and bull markets, where we're at now, what's history look like, and then Andrew's going to unpack what we have seen, which is truly a record recovery in these markets. So let's take a look at Fed policy and bull markets. So first, some context here. So there have been 11 bull markets in the modern era prior to this one. Some of them are long, some of them are a little bit shorter, but really 11 different cycles that we look at. This one that we're in started back in 2022 after we had that, I'd say, rough period for both stocks and bonds. But since then, we have been in a bull market. Came very close this year to challenging that, but nevertheless, we are here. One of the unique things that every period has uniqueness in its own way. But one thing that's truly been astounding this period is that this bull market has happened entirely without the Federal Reserve monetary support, something that is usually there. That's what this chart shows you. So the top panel has been the federal funds rate change during this cycle, which has been a series of increases, after we had already started. And then there have been 3 cuts. But what you see typically is that red line. That is the average change in federal funds policy during bull markets. During the first 7 months, you see an average of 1.25% reduction. And by the time we get out to 32, we are still there below where we had started. So versus this time, which we're expansion, but that has not stopped the bull. Mostly thanks to what we have talked so much about, a handful of stocks, the Mag 7 really driving it, maybe the powering force, which has allowed this to go counter to history. So as we go forward, as of right now, it is most likely that we see the Federal Reserve cut in September. July is not likely. Always a possibility, especially if we get a weak labor market reading up into that or something, truly surprising to the downside. But otherwise, September is the expectation. So, possibly as we get a little bit older into this bull market, we'll finally have Federal Reserve enter the fray. The other thing I would point to is we've seen, some positive movement outside that Mag 7, but nothing that you would really call, typical bull market type return. So that's one scenario. That'd be like the best outcome, is that we see the Federal Reserve join the party and see more stocks have bull type environment. So that remains to be seen. Obviously, if it doesn't come in September and they get late and we have something of a mild recession, all bets are off. So that's Fed policy and bull markets. Andrew, over to you to talk about this V.
All right, thank you, Adam. Speaking of bull markets, the current one we're in just hit fresh new highs. It feels like it was just a couple of weeks ago that we were talking about the market flirting with being in a bear market. In fact, that's exactly what's happened. It's only taken a couple of weeks for this market to really see a strong recovery. The chart that I'm bringing for this week's Market Carver is looking at the current recovery past similar ones that saw similar type declines. So I know there's a lot of different lines on this chart. It looks a little noisy, and I'll unpack it for you. What we have here is, if you look closely, you'll see an orange line. That's today. All the other lines are looking at prior declines in the stock market of 15 to 20% and how long it took those markets to then recover back to new highs. And then you look at the blue line, that's just looking at the average. What stands out is, as you can see, that orange line is fairly short. It's actually, in fact, the quickest recovery after a 15 to 20% decline that we've seen going back decades. This has been a really strong market. If you've been watching the Market Carver, you'll remember we've talked about how we saw the market drop 10% in 9 days and then get recovery of 10% in just 9 days. Very, very fast. And that's often what you have happen when you have headlines driving the market in both directions. So while we have the index now at new highs, we are starting to see it get a little bit of extended because it happened so fast. And when we look below the surface, I often am looking at how are the average stocks performing. We see what the index is doing. Is it getting support by all 500 stocks in the S&P 500? And that's something we talk about every Monday in our allocation call. looking at it today, we see that quite a few stocks are still in pretty deep declines. In fact, the average drawdown for the large cap stocks is still 15%. In fact, we have 57% of stocks are still down over 10%, and almost 1/3 are down more than 20%. What this tells us is that we saw a lot of stocks see a very severe decline during that first quarter, start bottoming out in April. And as we see the market recover, it was really being driven heavily. Again, feel like we talk about this quite a bit, heavily driven by those Nvidias, the Microsofts, those mega cap big tech names really help move the market forward. Well, that's not necessarily a major concern. These are the stocks that make up the most of the S&P 500, and we're seeing with it a lot of bullishness in those offensive sectors. The parts of the market people are buying are the ones you want to see the markets show preference to. Technology, communications, financials, things like that are doing really well. And so that's a positive confirmation for the newest high. What we do want to start seeing is seeing a lot more recovery in the average stock. Start seeing a little bit more participation, start seeing more new highs, things like that will help continue to support the overall index in case we start seeing those mega cap names begin to falter. So overall, we've seen a really strong recovery. It's getting support by the sectors that we want to see supporting, and we are seeing recovery from the average stock, but they're taking a little bit longer because they saw a much larger decline than what the index itself did. So overall, pretty bullish data. We still want to see more ground being made up by individual stocks, but we are seeing some bullish confirmation that's encouraging us as we see this really strong recovery that right now in the short term may be getting a little bit of extended, a little bit ahead of itself, but we still think that it's getting good support and still a bullish thesis there, as Adam was hinting to with his chart as well.
Yes, absolutely. And just maybe we can connect the dots there and have the Fed come in and give such that so many of those stocks underwater the lifeline that they need.
Right.
So we will see. But thank you so much for giving us your time. We hope you have a truly safe, fun, and enjoyable 4th of July holiday. If we can be of service in any way, please don't hesitate to reach out and give us a call, 800-928-4001, or scan the QR code and do it electronically. Thanks so much and have a great weekend.